2026 has been a year of global surprises, from geopolitical events to wars and roller coasters in equities and metals markets. In January this year, the gold price hit a record high of nearly $5,600 an ounce. That's going almost parabolic. In 2025, the gold price moved from about $2,500 an ounce to $4,500 an ounce. That's up nearly 65% last year. And in late February this year, the US and Iran went to war. By late June, the gold price had fallen by nearly 30%. Now that's one of the most volatile 6-month stretches in the history of the gold price. So if you're holding gold already or thinking about starting, here's why that happened and trying to understand where that could mean for the gold price going forward. So let's recap the moves. Gold spent January and February on an absolute tear, rising by roughly $1,000 an ounce from the end of 2025 and topping out at just under $5,600. In March, the US equity markets crashed though, mainly as a result of the Iran-US conflict. It sent the S&P down about 8%. And in turn, gold gave up that $1,000 again. So by April, it was trading at around $4,200. That's a brutal, fast correction. It chopped sideways for a couple of months, and in June, it slid to its lowest level this year, just under $4,000 an ounce. I think it was around $3,960. Since then, it's stabilized, and around today, it's trading at around $4,100, just north of $4,000 an ounce, or in Rand terms, it's about 66,000 Rand an ounce. So what actually happened? Well, there are 4 forces acting on the gold price or the gold price action. And understanding each one of these helps us understand where it might go next. First, the Iran conflict. Fighting broke out in late February, and Iran responded by choking off the Straits of Hormuz. That's the crucial thoroughfare for gold in the world. Crude oil flows through the strait had collapsed by about 90% and at its worst, and it was about down 30% on the quarter. And historically, the average daily flow through the strait was about 20 million barrels a day. As a result, the price of crude went from $65 to $120. Global strategic oil reserves, the emergency reserves that the International Energy Agency and governments use for a time like this, were released. And they would draw down to about 45%. So just keeping the supply moving. A ceasefire was signed in June by President Donald Trump in Iran, and it was done in Versailles, and it reopened the Hormuz. So it brought the crude oil price down to about $80 a barrel. It unfortunately lasted only about 3 weeks, and then fighting resumed. And it wasn't enough to rebuild those depleted reserves either. So the interesting thing was, though, that the effect on markets were less than anticipated. Markets were actually quite resilient. But the expectation now is that these elevated crude and petroleum products, which are more the downstream products that we use in our day-to-day, will feed into producer prices. So we're talking manufacturing, agriculture, energy, and it'll happen well into next year, in 2027. So this kind of revives that energy-driven inflation expectations for the global economy. But now, gold is the world's best inflation hedge. So one would expect a kind of shock like this, sending up expectations for inflation, should support the gold demand from a fundamental perspective. It didn't. And the reason the Iran conflict had this opposite effect had more to do with market mechanics and technicals. So when global oil supply experienced a sudden shock, it actually sent interest rates up in the US, spiked quite dramatically. And the reason is because this expectation of high inflation has to feed into the inflation or the interest rates. It's a component within an interest rate. And the world expected that the petroleum products that are used in day-to-day industries will also have a supply crunch. Another thing, though, from a technical perspective, is that professional money managers use gold as a portfolio insurance, right? So they don't necessarily look at it for long-term wealth preservation. They allocate percentage to the portfolio as an insurance against the other asset classes. So when you have a shock like that, they need to sell or deallocate some gold in order to cover margin calls in other areas of their portfolio. So interestingly though, the gold price actually took a hit as a result of the war and the spike in interest rates, but it's more of a short-term move. So that's factor number one. But let's talk more broadly as a second factor about interest rates. Now, we've said this before in our previous nuggets that USD gold prices are effectively a factor of real interest rates. Right? So that would be the nominal interest rate on dollar bonds or US bonds minus the inflation rate. And if you do that, if it's greater than zero or the real interest rate is positive, it basically means that dollar holders or people that hold US dollars can choose between gold, which is a wealth preservation asset, that's not a liability and not debt, so it doesn't pay a yield though, or they can put it to Uncle Sam and give it into their US bonds, and if it's positive, they can earn some real yield. So that usually keeps the gold price suppressed or puts a ceiling on it. So positive real interest rates are tough for gold. And that's exactly what we've been seeing in the world recently with the spike in interest rates. But conversely, if inflation runs high and real interest rates are negative, it usually supports the gold price. Reason being is you would rather put your money into gold, your US dollars into gold, and preserve your purchasing power than give it to Uncle Sam and actually get a negative carry or a negative yield and return on that money. But since 2021, governments have pumped massive amounts of currency into the economy. It was a result of the COVID-19 pandemic, and it was in the wake of that. So interest rates have shot up since then, from about 2021. So this has been the dominant force pulling down the gold price recently. And what's more, the Federal Reserve and their actions, so there's a new chair, Kevin Walsh, and he's held rates steady at around 3.5%, 3.75% across the last 4 meetings. And he's also taken out any wording that makes it dovish or makes the markets think that the Federal Reserve will lower interest rates. That's pushed the dollar index above 101. All right? So it means the dollar has strengthened, and it's been its strongest level since about 2023. So the dollar strengthened, and markets expect the Fed to be hawkish or sort of keep rates high. And gold fell then relative to the dollar the past 6 months. So again, for the number that actually matters, the real interest rate, the nominal rate minus inflation is key. That's what we really look at Troy when we analyze the gold price. But just to put that into perspective on rates at the moment, back in the depths of COVID, the 10-year US Treasury yield was around 0.5% or 50 basis points. Today, it's around 4.6%. That's a 762% increase in the interest rate, or the cost of money effectively. The 30-year bond has moved from about 1% to 5%. When bonds pay that much more, it becomes harder for gold owners to maintain or professional investors to maintain their asset allocation to gold versus US bonds. And that's been the single biggest drag on this year's or the previous year's rally, even with the geopolitical risk that we had last year. Factor number 3 is inflation itself, right? Gold is the inflation hedge. Inflation actually re-accelerated. And we've seen that because the May CPI hit 4.2% in the US. Now, that's the highest print in the last 3 years. Usually the Fed's trying to maintain the interest rate at about 2%. It's more than double that at the moment. And it's largely on the back of these energy costs. So normally that is obviously bullish for gold and gold prices. And that's really what's driven, gold prices substantially in the previous year. But investor money did leave in the short run, unfortunately. And they did that because professional money managers shifted back into technology stocks when there was a correction in the gold price. For example, gold ETFs, which are a debenture instrument or credit instrument for gold, shed 16 tons in May with outflows that continued in June when the gold price came down. So it's left roughly about 300 tons of ETF gold sitting underwater by close to $4 billion. They need to sell a very liquid asset to cover their credit or leverage positions in the rest of their portfolio. This, however, won't stop the oncoming wave of inflation in 2027. Right? Because remember, it's important to understand innately why these bond yields have increased. Right? So in bonds, there's an inverse relationship. When a bond yield goes down, the price goes up. When the bond yields go up, the prices go down. So bonds and US dollar bonds, the prices have gone down, which actually really means that institutional buyers and what we call official sector buyers like central banks don't want to buy as much US bonds as what they did historically. Right? And that basically tells us that they are distrustful of the value of the dollar going forward. They actually believe that inflation will come down and that the US government will print a lot of money or deficit spend a lot more. So they want less US dollar bonds, and the US Treasury needs to increase the interest rate just to get people to buy it. So that's technically and fundamentally a great sign for gold. It's a forewarning effectively of inflation coming to reduce the power of the dollar in the future. And then fourthly, and this is probably also a really important one in the long run, is that central banks are still buying aggressively, right? A World Gold Council survey recently of a record 76 central banks found that 89% of them expect gold as a percentage of global gold reserves in central bank balance sheets to increase. And a record 45% of them have been planning to add to their own holdings. So China, Uzbekistan, Poland, these are the guys that have been stacking up for the last decade, have all been buying in June as well. So they've continued a run that's seen central banks buy about 1,000 tons a year of gold over the past 4 years. And that's more than double what you had during the period of the financial crisis to COVID, 2021. And that's important. Global demand, 1,000 tons in global demand is huge. But let's talk the sovereign debt numbers effectively. You know, what's driving the fact that central banks aren't trusting government finances or Uncle Sam's finances? The average debt to GDP now across developed G7 nations today sits at above 110% of GDP. And that's roughly double what it was in 2008 during the financial crisis. So during the financial crisis of 2008 and the COVID era of 2021, that debt piled up and that increased at effectively a near zero interest rate environment. It was a free money world. Today, that rate sits several 100% higher, like we said, 700% higher, meaning that governments now have to refinance a debt pile that's twice as large at dramatically more expensive rates. That combination forces higher taxes, more deficit spending in nations, currency debasement, and slower economic growth in an economy. So that's sort of like the slow burn story underneath everything else that we've been seeing in this market. So how do we square up a 30% drawdown or correction against a backdrop like that? Honestly, this correction was overdue, right? And it was healthy. If gold ran up $1,000 within about a week, it goes parabolic and it gets crowded with speculative traders and algorithmic traders. And you need to unwind traders like that. And it usually happens fast. And that's exactly what we saw. The gold price dropped again by about $1,000 in April, cleaning out the speculative overcrowdedness in that market. It's a healthy reset, effectively. So what we've seen in April is more technical than fundamental. A stronger dollar, higher yields, forced selling. It's not a reversal of the underlying case for gold. So where does that leave us in terms of the gold price or gold price action, like we said? Bank forecasts have indeed come down, and mainly as a result of a new conflict or war, like the one we've seen with the US and Iran. Standard Bank was calling for $7,000, $10,000 an ounce as recently as April. But since then, Goldman Sachs has cut its year-end target to $4,900. Deutsche Bank to $4,800 an ounce. And JP Morgan slashed its call to $4,500 an ounce. The World Gold Council, in its own view, is a little bit more balanced. They just let out a half-year outlook, and under current conditions, they said, gold will sort of trade sideways, maybe a 5 or 10% difference, but the stage is still set for a possible breakout. So effectively, on the upside, if we do see economies worsen, if we see interest rates actually pushed back down because governments are forcing their central banks to try to lower the cost of money again, or if we see another geopolitical shock, high inflation, we'll definitely see the gold price be able to go up again. On the downside, if there's actual growth in the economies and there's rising yields in calm markets, gold could slip. But the World Gold Council has said that a fall of more than 10% would likely be tempered by bargain hunting demand. So it's important to see in the context, though, if we step back a bit in terms of the annual rates of return. Over the last 3 years, in USD terms, gold has moved from $2,000 an ounce to $4,000. It's doubled. In Rand terms, from the same period, it's jumped from about $34,000 to 68,000 Rand an ounce. On a compounded annual growth rate, that's 25% and 26% respectively. That's huge. Here's the bottom line. The debasement trade, which is unsustainable government debts, forced deficit spending by governments, central banks quietly de-dollarizing themselves, hasn't gone anywhere. If anything, the numbers we just walked through have strengthened the case for gold, not weakened it. What's changed right now is the short-term weather. We've had a stronger dollar, high interest rates as a result of a war, and that's been winning right now. But the structural case for gold today looks more compelling than what it did even in January.